Is Oracle's $300 billion OpenAI bet a brutal strategic mistake? You know that moment when a company bets big, and it either becomes legendary or goes down as a cautionary tale. Well, Oracle might be writing its version of that story right now. This week, the tech world is buzzing. Not about another AI breakthrough, surprisingly, but about a financial nosedive. Oracle's stock has taken a serious beating, down over 40% since September, wiping out more than $360 billion of its market capitalization. And a whopping $67 billion of that loss happened in just one day. Yeah, one day. Welcome to the L-Impact Solutions podcast, where we break down the biggest stories in business and finance and look at what they really mean for the markets, for companies, and for you. I'm glad you're here, because today we're digging into Oracle's $300 billion bet on OpenAI, and the growing signs that this gamble might be getting a little too expensive. Now, let's start by setting the stage. Oracle, for years, has been known as one of the stalwarts of enterprise software. It's a company that built its empire on databases and cloud solutions for big businesses, competing head-to-head with giants like Amazon, Microsoft, and Google in the cloud computing race. But in the last year, Oracle decided to go all in on artificial intelligence, specifically by tying itself very closely to OpenAI, the same company behind ChatGPT. At first glance, that didn't seem like a bad idea. OpenAI has been the poster child for the AI revolution. It's got everyone talking, from startups to boardrooms to policymakers. Every company wanted a piece of this new technology. So when Oracle started marketing itself as OpenAI's primary infrastructure partner, offering the computing power that fuels training these massive AI models, Wall Street applauded. Investors piled in thinking, hey, Oracle's found its AI play. But here's where the problem started. Oracle's dependence on OpenAI grew so fast that, essentially, a huge part of its future revenue projections hinged on that one client. You can think of it like this. Imagine you run a restaurant, and 60% of your business comes from one really rich customer who eats there every day. Sounds great, until that customer skips a few weeks or decides to go somewhere else. And that's more or less what investors are worried about. The latest quarterly earnings report revealed that Oracle's growth in AI infrastructure isn't translating into the profits everyone hoped for. The costs of running AI workloads, these massive graphics processing clusters needed to train generative AI models, are enormous. Oracle is spending heavily on hardware, energy, and data center expansion, especially as it scrambles to keep up with rivals like Amazon Web Services and Microsoft Azure. Let's unpack that $67 billion single-day loss. It wasn't just a number pulled out of nowhere. After Oracle released its fiscal second quarter results, it became clear that even with higher revenue from its cloud business, profits were underwhelming. CEO Safra Catz tried to reassure investors that the company's partnerships, including OpenAI, were positioning it well for the future. But the market wasn't buying it. Analysts quickly pointed out that Oracle's earnings guidance didn't align with the level of capital it's deploying for AI infrastructure. In simpler terms, the company's spending much more than it's making from this bet. Now, to understand how this got so big so quickly, let's zoom out a bit. Oracle's partnership with OpenAI was meant to position it as a major alternative to Microsoft in powering AI models. OpenAI, after all, already relies heavily on Microsoft's Azure cloud platform. So Oracle wanted to grab a slice of that computing demand by offering additional capacity, basically saying, hey OpenAI, when Microsoft can't handle all your traffic, we've got you. And for a while, it seemed like that strategy worked. Oracle's revenue tied to AI infrastructure skyrocketed. But here's the catch, it wasn't sustainable. The cost of maintaining those high-performance data centers that can handle AI workloads has been rising faster than expected. GPUs from NVIDIA, essential for AI training, aren't getting cheaper. Electricity costs are surging globally. Cooling those enormous data centers, often located in places like Arizona or Texas, is a logistical nightmare. And then you factor in competition. Every major cloud provider wants a piece of this AI boom. Amazon's AWS, Google Cloud, and Microsoft Azure all have billion-dollar AI infrastructure programs running in parallel. So Oracle's margins, which were never huge to begin with, are being squeezed from all sides. There's also a deeper strategic question. Is it wise for Oracle to bet so narrowly on one AI partner? Yes, OpenAI is a big name, but the AI landscape is now crowded with players. You've got Anthropic, Cohere, Mistral, and a host of open-source models gaining serious momentum. Oracle might have tied itself too closely to one star just as a constellation of new players started lighting up. And investors are noticing this. That's the heart of the panic. They're seeing a company that's putting billions into powering someone else's business model, instead of building its own differentiated AI ecosystem. Microsoft didn't just supply infrastructure to OpenAI. It integrated OpenAI tech into everything, from Word to Teams to GitHub. That's vertical integration. Oracle, by contrast, is more like the landlord who built the building but doesn't own any of the companies renting its offices. Let me share a quick comparison from the financials. Microsoft's revenue from AI services through its Azure platform has surged by double digits each quarter this year. And beyond that, it's able to monetize AI features directly to users, through Copilot subscriptions, for instance. Oracle, however, depends on bulk infrastructure deals that are harder to scale profitably. So even if Oracle racks up huge revenue figures, the profits get eaten by the cost side almost instantly. Now, that doesn't mean Oracle is doomed, far from it. But it does mean it's entering a phase where strategy has to evolve fast. The company still has strengths that few others can match: an enormous global customer base, deep integration in enterprise IT systems, and a reputation for reliability. These can be massive assets if Oracle pivots the right way. Here's one angle they could explore. Instead of just being the engine room for someone else's AI, Oracle could focus on building AI applications and analytics tools specific to industries, say AI-driven automation for supply chains, databases that self-optimize using machine learning, or sector-specific AI services for finance or healthcare. These are areas where Oracle already has credibility. Turning those into AI-powered solutions could balance its heavy infrastructure investment with a steadier, higher-margin revenue stream. There's also the question of timing. Oracle made its OpenAI move at a moment when everyone thought AI demand would grow linearly, just straight up forever. But now we're seeing a slight correction. The broader AI market is still expanding, but not every company can afford these massive training runs. Many are switching to smaller, specialized models or turning to open-source alternatives. That could undercut Oracle's AI hosting business if demand for megascale compute slows down. We've also got macro factors at play. The Federal Reserve's stance on interest rates, which remains somewhat restrictive, affects tech valuations. Investors are now exercising more caution. A company like Oracle, which once looked like a safe bet because of steady enterprise revenue, now looks riskier because of its new capital-intensive trajectory. Think of it this way. Oracle used to be a marathon runner. Reliable pace, predictable results. But suddenly, it's decided to sprint, investing billions into AI hardware and data centers all at once. And while that sprint might pay off if AI demand keeps soaring, it also risks burning out before the next water station. The good news is that Oracle's leadership understands this tension. CEO Safra Catz and founder Larry Ellison both emphasized during the earnings call that the company remains committed to long-term AI partnerships and doesn't plan to slow expansion. Ellison specifically mentioned that the company's data center footprint will double in the next 2 years. Ambitious? Absolutely. Risky? Definitely. And that's the duality of today's AI-driven tech environment. It rewards boldness but also punishes missteps instantly. One disappointing earnings call, and you're out $60 billion in market cap. Investors have become much less forgiving. Let's also not forget the ripple effects. Oracle's tumble affected broader sentiment across the AI and cloud sectors this week. Tech-heavy indices like the Nasdaq took a slight hit as traders reassessed how sustainable AI profits really are in the short term. There's a feeling that the market might be entering what some analysts are calling the AI efficiency phase, moving from hype-driven investments to profit-driven scrutiny. Companies will no longer get a free pass just for saying AI. They'll have to show how it's improving margins. That shift in sentiment could reshape corporate strategies across the board. We might start seeing fewer splashy AI announcements and more focus on use cases with tangible returns. Things like automation, cybersecurity, and data optimization. In that landscape, Oracle's model could still thrive, but only if it can reduce its dependency on one flashy partner and spread its bets. And while Oracle wrestles with its AI identity crisis, there's also a perception issue. The company has always been known for strong enterprise relationships. It's trusted, it's stable. But now it's trying to be seen as fast-moving and innovative, almost like a startup. Balancing those two images is tricky. Customers expect consistency from Oracle, not risk-taking. On the other hand, you could argue that Oracle is doing what every legacy company must eventually do: reinvent itself before it becomes irrelevant. The cloud market has matured, and margins are thinning. AI is the natural next frontier, and maybe Oracle just moved a bit earlier or more aggressively than it could financially handle. So what's next? The near term will likely be volatile. Analysts will scrutinize whether Oracle can manage its capital spending better and diversify its AI portfolio beyond OpenAI. Investors will watch closely for new customer wins in other AI segments. And internally, Oracle will probably have to make some tough calls on where to cut or reprioritize investments. For now, it's fair to say that Oracle's $300 billion OpenAI bet showcases both the promise and peril of this AI gold rush. The returns could be massive down the line, but the pain is being felt right now, in share prices, margins, and investor confidence. So, what do I take away from all this? Well, we're witnessing a transformation, not just in Oracle, but in how the market understands AI investments. The easy money phase is over. The survival phase has begun. Every tech company now has to prove that AI is more than just a buzzword. It's a business model that works. All right, that's all for today's episode. If you've been following Oracle or investing in AI-related stocks, I'd love to hear your thoughts. Do you think Oracle's bet on OpenAI will eventually pay off? Or is this a sign that the AI boom is cooling down faster than expected? Let me know your take in the comments. And as always, thanks for tuning in to L Impact Solutions.